tell us at the moment whether this is a systemic issue across banking, and also what it means for crypto companies such as yourself.
Well, it's fascinating, actually, because if you think about the core of crypto and what Bitcoin is about, it's really about the opposite of fractional reserve banking. It really is about distributed, not having to take counterparty risk. I won't take credit for it. Mark Yusko from Morgan Creek basically does a great job. His point is crypto is truth technology to replace the need for centralized trust. And so long-term, events like this are massively bullish for the crypto complex. Now, many of the assets in crypto will actually be hurt by this. Bitcoin, I think, will be helped, and we'll see how it goes. As far as is this systemic or not, that's a different question.
Well, you were tweeting earlier, Dave. I'm going to bring one of your tweets up on the screen, but your basic argument is that the contagion risk, the risk from the banking system, is actually much more potentially damaging to crypto and tech than it is to banks from crypto. Explain your logic here. What do you mean in this tweet? What are you trying to say?
Well, I mean, at the end of the day, every time there's been an incident in crypto, it hasn't spilled back over to the mainstream until FTX. Now, FTX is separate from all the other failures, right? So we had three huge failures in 2022 in the world of crypto. All were preventable with principles-based regulation that we should have had, and should actually build, but don't have, right? The first was lots of money in a stable coin that wasn't stable. I had $0 in Luna, $0 in UST, thought that basically the whole notion of an algorithmic stablecoin to me sounds like a Ponzi scheme. It's recursive, to use a quantitative term. And ever since Basis came out with their first white paper, despite the pedigree, academic pedigree of the authors, I thought it was a terrible idea. I still think it's a terrible idea, and I probably will, whatever. So that was that one. And regulations that say stablecoins have to be fully backed makes that not be a problem. The second, which was far worse, was from bad disclosures. And there's probably the only point that I know of that Gary Gensler and I agree on completely, which is firms should have to disclose their risks, right? The third one, which was FTX, was far more like Madoff than like anything else. They simply gambled away somewhere between $8 and $10 billion and stole it from their customers. That had nothing to do with crypto. They could just as easily have been doing sports betting. Doesn't matter. They lost a lot of money and stole it. That's not a systemic risk from crypto. That's a massive theft. So if you actually look at everything else, all the other major volatile events in the history of Bitcoin and crypto has never really spilled over to the traditional financial system because there really isn't a lot of impact there. But
so Dave, 24 hours ago, Caroline and I were having this discussion that actually this is all the net result of higher rates. And what higher rates have done, Caroline, right, is cut froth out of the market. Where is the most froth? Well, according to Bloomberg reporting, it was in the crypto sector.
Yeah, and ultimately that was what the demise behind Silvergate, because people had to pull their deposits. Then, of course, the tech community needing to pull their deposits to basically get through the cash burn. And Dave, now, you were just mentioning stable coins, and I'm interested as to what happens if some of the key stable coin proponents, some of the companies behind it, have relationships with Silicon Valley Bank.
That is a great question, and I wish I knew the answer. I don't know Jeremy Allaire from Circle. I'll be perfectly blunt about it. We've never met. But if I were running Circle, I would have had 98% of my deposits in T-bills and T-notes. There's no reason to have bank investments. You need banking for liquidity on the margin. So it should be a very small amount. Now, why do I say that? It's because I'll tell you, at CoinRoutes, for example, we were offered bank savings accounts, and we compared that to 3-month and even 30-day T-bills for our cash needs. And the reality is you get multiple percent higher by investing in government debt, which is obviously far safer than you do in banks. So the real issue is if you look at bankrate.com, they'll tell you the average savings account rate is 0.25 or 0.23%. So one has to ask oneself the question, why are people leaving money in bank deposits? That's a really, really interesting question. And I don't know the answer to that. I can tell you at CoinRoutes, our treasury for our 3 years plus of runway is sitting either very large banks or in treasuries.